back to another episode of Toce Talks with Gianni Toce and
AJ Toce.
How's it going, bro?
Going good. I have like a guilty pleasure kind of thing because when markets go down a bunch, I'm actually like kind of secretly rooting for it. Like, I want to buy them because I'm always
I'm 10 years younger than you, even more so.
Yeah, you had we weren't even thinking about selling these stocks anyway. So it's like, right. But I was definitely thinking about buying. I mean, I've once your money's on autopilot, you're buying more stock every month. So yeah, we call that the accumulation phase, where you're just trying to accumulate quality assets and hold on to them for as long as possible, or until you're ready, ready to sell them much later. But even then, I would argue that you really can
better things to do.
Well, yeah, I mean, you can borrow instead of sell,
right.
And that's what I hear a lot of people lately talking about what the wealthy do with their money. Of course, it's whatever the person is selling is what the wealthy do with their money. Like all the wealthy are, doing infinite banking and all this stuff.
They're buying annuities and insurance.
Yeah, which maybe they're doing that with the 10th and 20th million dollar that they make, but I guarantee that's not how they got wealthy, and that's really the point. It's like,
right,
it's not how you get wealthy. Maybe it's a way to stay
wealthy.
Yeah, but we're in the accumulation phase, so I'm actually doing great. I'm looking at stocks on sale. What's the cliche? Gee, this is only
only store where everything goes on sale and people run outside.
And people the only market where things go on sale and people run out of the store. Yeah. So. Yeah, I mean, it's a psychological game. One of the things that I've noticed in general is most of the money is owned by the older crowd, right? Because they've been accumulating all their lives, and their mindset and their outlook and their goals are so different from ours. But that most of the money, most of the market action is happening as a result of their whims and desires and all of that,
Yes.
And so that's a big reason why, I think most people will look at the price action of something they bought, a stock or a fund or something, and they'll decide whether or not they made a good investment by what the price is doing right now.
Wait, and what does that have to do with the? Just saying because the older generation's money's moving it, but.
Just because someone who's 65 is selling out of the market or selling out of the stock doesn't mean that has no bearing on
what you should
your
do.
plan and what you should do. Yeah,
right.
In fact, you could. I mean, and that's kind of what I'm getting at. Is I see that as an opportunity for me. What's the most valuable thing we have? Time. I got 30 years to sit and wait. I don't need to sell. If I needed my money, 2 years from now, I wouldn't be in the stock market.
Yeah.
Or I would be very lightly invested.
Yeah.
But that's because you don't know what the heck's going to happen in 1 year or 2 years. It's always the unexpected thing, like the global pandemic that no one sees. That's the stuff that gets you, and you never know when it's coming.
Speaking of not expecting what's going to happen, how about the last couple months of market action, or last 6 weeks, 8 weeks?
Yeah. Well, honestly, in hindsight, of course, everything's clear. But in hindsight, it's of course this was going to happen. Every time there's a wretched excess or irrational exuberance. These are the cliches.
Correction.
I mean, anytime there's a speculation, speculative boom on the upside, like we had the past couple years, it's almost always led by a subsequent decline. It's not always like a crash. They say it doesn't have to end with a bang. Usually it ends with a whimper, and that's what we've been seeing over the past several months. It's just this bleed out, and every time people are like, okay, is this the bottom? Is this the bottom? It's nope, there's another leg down.
Yeah, it's called,
first it was only the small stocks getting hit. Now it's Netflix, Facebook, Amazon
Apple down a lot.
Yeah, Amazon's down 30-something%. Maybe more now. I haven't looked today.
And Facebook got cut in half.
Facebook got cut in half. Yeah.
That's crazy to say out loud.
I know. Yeah, I mean, I didn't necessarily see it coming, but man, that's still nothing compared to a lot of the stocks that are getting crushed.
Yeah. What's the quote? A stock that's down 90%, or a stock that. How's it go?
A stock that's down 90% is a stock that was down 80% and then got cut in half. Yeah.
Ouch.
Yeah. How much further goes that's the Peter Lynch line. He's going this low. How much lower?
How much lower could it go?
A lot. It can always go lower. That doesn't mean it should go lower. That's the point. It's it doesn't mean that would be justified for it to go lower. It doesn't mean it's rational for it to go lower, but it means that you never know when people get out of the logical and into the emotional, irrational things happen.
Yeah, when the value of your holdings, if you're all piled into one stock, goes down 90%, I bet you're going to be feeling a little irrational.
Yeah, I would be feeling very irrational if I let that happen.
Yeah.
So what we see now is over the past couple years, honestly, like, I kept my mouth shut most of the time, but I'm not gonna lie, it was kind of it was upsetting to see so many people like, oh, day trading's the new thing. Like, oh man, why do I even have a job? I should just be trading options, you know. And you see that there's no, like, the train runs out of tracks.
Yeah,
right.
You see the calamity on the horizon. You don't know when it's going to happen,
but it's like
I know you're not going to make a living day trading.
And it's almost a certainty that I talked to somebody who was up like 700%. So they were one of the AMC people, and it just so happened I was leaving. We were going to the Buffalo River on June 2nd, and on the way up, I'm calling people, and it was somewhere around that, like, early June, that AMC hit its actual top at like 77, I think. And I'm talking to a client of mine who said he's now got like 70 grand in this stock, and I was like, man, I could tell that he felt he was with the crowd, you know. So it was like ape strong together, you know, diamond hands, and don't sell. And so he felt like he couldn't sell. I'm like, you do what's best for you and your family. Okay?
Yes.
People, they'll get over it, you know. But of course he didn't, and now it's down to like $11. And he kept on talking about how he's buying the dip on the way down, which means even if you bought at 5, got up to 70, if you buy on the way down, well, when it gets to 20, you would have 4x'd, but now you're in the hole.
Yeah.
And I've seen that with a few people, but also it's like, if you make a bunch of money in the market, what are you gonna do? Sell it, cash out, and never trade again? Like, that never happens. So even if you won, even if you cashed out of that stock, if the money's still in the account, if you're looking at more bright ideas,
unless you immediately hire an advisor and they're like, okay, here's what we're gonna do, and you do it.
Yeah, if you were to change your pivot before it's too late, but man, it's so rarely do that.
That's essentially timing the market, kind of, or timing your life decision to.
It's been described as like stopping sex right before the end. It's like no one ever wanted. It's like when you want to stop the least is when you're making all this money. It's got crazy. The chemicals are firing in your brain. Like, that's the last thing you're thinking about is, I'm gonna just hop off and stop doing this.
Yeah. What an illustrative example.
Yeah.
But accurate, very accurate.
One thing we all have in common. That's how we got here.
Yeah.
It's relatable. Relatable content. I hear it's important. So, a lot of people thought that they were just smart and talented or whatever, and didn't want to admit that it was actually luck. Yes. And now the luck's run out.
Now the luck has run its course. And The Psychology of Money by Morgan Housel, which we talk about on this podcast a lot. Chapter 2 is called Luck and Risk. And the whole chapter is sort of about, you know, how much can we tease these two things apart?
Like figure out which is is causing your fortune or misfortune.
Exactly. Which one's causing your fortune or misfortune? And the answer is you can't. You really sort of can't. Maybe in some specific cases. But not only, you can't really tease them apart, but we know that they both have an effect, right? We just don't know how much of each one.
Yeah, I took a class called Quantitative Methods, and the goal was to try to figure out, like, you try to answer the question, how much of our increase in sales is due to this TV commercial that we ran.
Right.
You know, and you try to run some crunch numbers and see how much, and you can get to a certain statistical significance. Like, probably, we're 80% sure it probably, 25% of your new sales are accounted for by this commercial, whatever. But it's a rough science.
Yeah, Mark Twain said there's two types of statistics: lies and damn lies. So.
Yeah, exactly.
But That's not quite the same thing. I think he's more so talking about, people using statistics dishonestly. Because you can make numbers say whatever you want them to, kind of.
What do they call it? Like torture reality to fit your model?
Yes, torturing
reality to fit your whatever preconceived notion.
Yeah.
So what do we do? Like, is there some sort of takeaway that I can like use in my life now? Like, just acknowledging. Maybe it's just an exercise in humility.
It's definitely, I agree with that. Absolutely an exercise in humility. The takeaway, if you can learn a lesson from that humility, and maybe the lesson to be learned is, I don't know how to invest. Because I really...
That's a hard one. It doesn't feel good to hear at all.
Right, because it's so easy for anyone to do it now, or at least, not successfully, but for anyone to do it. With the internet and Robinhood, like 20 years ago, the bar of entry was 100 times higher than it is now. But that doesn't mean everyone got better at investing or learned how to do it or how to actually work the fundamentals. And
so it's a good thing that more people are investing. Like, it's a really good thing.
Absolutely.
And I was saying that back there, like, okay, I guess they're gonna have to take their licks and learn the hard way that this isn't the way to do it. But I think a lot of people have been introduced to markets. They know now that they can go in and buy a stock, and I think everybody's heard of buy low sell high. They've heard of buy and hold, but when you're young and dumb, when I was 18, I wouldn't have listened to that. I'm like, maybe that's true for y'all, but I'm smart, I'm unique, I'm different.
Exactly.
I'm gonna break the mold. I'm gonna figure it out.
Yeah.
But once you get over that. That's kind of like tuition. Better to pay when you're 18 than when you're like 38 or whatever.
That absolutely. The earlier you learn that lesson, the sooner you can start compounding your wealth and not
get squandering it. Yeah, don't get felted. Howard Marks said, maybe we can close out with another quote. I like my quotes. Leaning on the wisdom of other people. But he said that
we stand on the shoulders of giants.
Exactly. And Howard Marks is a giant of the business. He said, let me make sure I don't mess it up. He said, okay, the 4 most dangerous words in investing is what he said. It's different this time.
Yes.
And it did feel that way. It really did feel that way these last couple years.
But this time
is it different? But it's not. It's not. And in hindsight, it's like obvious.
It's not because, I'll tell you why it's not. Because the only thing that matters is how much money is this company going to disgorge between now and Judgment Day? Can I hold it until then? Who's running the company?
And what are interest rates?
And
that's definitely not different this time.
And that's definitely not different.
Which could be the subject of another podcast. We could talk like market mechanics a little bit. Because interest rates, inflation, and like it all ties together. I don't really think... It took me a while to like wrap my head around what it all means.
I'm definitely still trying to.
Maybe we can do like a little miniature on that.
Yeah, a live...
well, maybe a little whiteboard lesson.
You give me a live crash course on interest rates.
Okay, yeah, we'll do that.
All right. Well, stay tuned for that.
See you later.
Hey guys, if you like what you just heard, then please check us out on social media. Our links are in the description below. We'll see you next time.